Pay close attention because what I'm about to share could very well determine whether you enjoy a comfortable retirement or end up scraping by in your golden years. I'm not exaggerating. We need to have an honest conversation right now about something that genuinely scares me when I study the data, and believe me, I examine data every single day. That's my job. I'm Mr. Wonderful, and I don't sugarcoat anything when it comes to your finances. Before I reveal the 3 safest exchange-traded funds every retiree should have, I need you to do something immediately. Hit that subscribe button. Smash it. Why? Because this channel is all about protecting your wealth, boosting your cash flow, and ensuring you never run out of money. If you truly care about securing your financial future, you need to join this community. Subscribe and activate notifications, because the advice I provide here could literally save your retirement. Now, let's discuss what's really going on in the financial world. Every day I meet hard-working, responsible people who did everything right. They saved diligently, contributed to retirement accounts, and followed their financial advisor's guidance. Yet, despite all that, they are terrified. Completely terrified. They watch the markets swing wildly, accounts rising one day, plunging the next, and the stress keeps them up at night. That's no way to enjoy the rewards of a lifetime of work. Here's the harsh reality no one wants to admit: most retirees are not truly prepared for a significant market crash. They may think they are, but in reality, they're not. Many retirees have portfolios stuffed with individual stocks, or they're invested in funds that are far too aggressive for their age. Even worse, some are just sitting in cash, earning virtually nothing while inflation quietly eats away at their purchasing power like a relentless disease. Every one of these approaches is a ticking time bomb. Do you want to know what truly keeps me awake at night? It's not my own portfolio, I can handle that. What worries me is the millions of people out there who are just one market downturn away from having to return to work at 75. That's a tragedy, and it doesn't have to happen if you understand what you're doing. Here's something that may surprise you coming from me: when you're retired or on the cusp of retirement, you can no longer afford to gamble with your money. The rules change. When you're young, you can take risks. You can swing for the fences. You can pour money into growth stocks, cryptocurrencies, and other high-risk investments. Why? Because you have time to recover if things go wrong. But when you're retired, you don't have that luxury. You don't have 30 years to wait for the market to bounce back. You need access to that money now to pay bills, maintain your lifestyle, and enjoy your life. That's why I focus obsessively on safety and cash flow during retirement. Notice I said both safety and cash flow. You need them working together. You can't just stash your money under a mattress, and you can't chase the highest yields blindly without understanding the risks. What you need is a strategy that protects your principal while generating income you can actually live on. That's exactly what I'm going to show you today. The 3 exchange-traded funds I'm about to reveal are not flashy. They won't make you rich overnight, and they won't double your money in 6 months. But here's the thing: these funds will do exactly what you need. They will protect you when the market tumbles. They will provide reliable, consistent dividends. And they will give you peace of mind, letting you sleep at night knowing your retirement is secure. That kind of stability is worth far more than all the risky gambling in the world. Let me explain why exchange-traded funds are ideal for retirees. First, they provide instant diversification. Instead of relying on a single company that could fail tomorrow, you're invested in hundreds or even thousands of companies within one fund. That spreads your risk across many assets. Second, they're liquid. You can sell them any day the market is open. Try doing that with real estate or a private business, it's much harder. Third, the fees are extremely low compared to mutual funds. I despise paying unnecessary fees. Every dollar spent on fees is a dollar that isn't working for you, not generating dividends, not compounding. Fees are the silent enemy of wealth. Here's where most people get it wrong: they assume all exchange-traded funds are the same. They are not. There are thousands out there, and the majority are outright junk. Some are too aggressive. Some are overly concentrated in a single sector. Some carry high fees that will quietly drain your portfolio over time. And some are poorly designed products meant to enrich the fund company, not you. That's why I spent months meticulously researching and analyzing to identify the 3 safest options for retirees. I examined historical performance during market crashes. I reviewed dividend yields and growth. I scrutinized expense ratios. I analyzed underlying holdings. I considered everything because when it comes to retirement money, you cannot afford even a single mistake. One wrong choice can cost you years of financial security. Before I reveal these 3 funds, I need to make sure you grasp something crucial. The goal here isn't to get rich. If you're retired and still chasing wealth, you're playing the wrong game. The objective is simple: preserve your capital and generate steady income. That's it. Boring? Maybe. But do you know what's truly not boring? Having enough money to live life on your terms for the rest of your years without worrying about running out. That's freedom. That's the foundation we're building here. When a market crash hits, and trust me, it will, most people panic. They watch their portfolios drop 20%, 30%, and they sell at the bottom because the losses feel unbearable. That's the absolute worst move you can make. But with the right exchange-traded funds, panic isn't necessary. You're protected. You're diversified. And you're still earning dividends even as the market collapses. I've weathered multiple market crashes during my career. I've seen people lose everything. I've also seen others, the smart and prepared ones, barely flinch while everyone around them panicked. The difference between these groups is strategy, having the right investments in place before the storm hits. You don't buy insurance after your house burns down, you buy it before. So, what are the 3 exchange-traded funds I trust for retirement money? I'm going to break down each one, and I need you to pay close attention because the details are critical. This isn't about buying something because it sounds appealing. You need to understand exactly what you own and why you own it. The first exchange-traded fund on my list is a Dividend Aristocrat fund. So, what exactly is a Dividend Aristocrat? These are companies that have consistently increased their dividends every single year for at least 25 consecutive years. Think about that for a moment. 25 years of steadily rising dividends means these companies have survived multiple recessions, numerous market crashes, and countless economic crises, yet they still found a way to reward their shareholders with more money each year. That kind of reliability and stability is exactly what you want in retirement. This fund is packed with businesses like Coca-Cola, Johnson & Johnson, and Procter & Gamble. These are companies that sell products people absolutely need. No matter the state of the economy, people continue brushing their teeth during a recession. They still buy essential household goods. They still require healthcare. These are defensive companies with exceptional track records. And when you invest in them through this exchange-traded fund, you own all of them in one simple investment. Here's why I love this fund for retirees. First, the dividend yield is solid, typically around 2.5% to 3%, providing dependable cash flow you can rely on. Second, the dividends grow over time, which helps protect against inflation and maintain your purchasing power. Third, and this is crucial, when the market crashes, these companies hold up far better than most others because they are essential businesses with strong balance sheets. During the financial crisis and the pandemic-driven market crash, these dividend aristocrats dropped less than the broader market and recovered much faster. That kind of resilience is exactly what you need when your retirement income depends on your investments. Finally, the expense ratio on this fund is exceptionally low, usually around 0.35% or less. That means more of your returns stay in your pocket rather than going to a fund manager who may underperform the market. I absolutely cannot tolerate high fees. They are direct attacks on your wealth. In retirement, every single dollar needs to be working for you, not lining the pockets of Wall Street. Now, let's move on to the second exchange-traded fund, and this one is all about bonds. I know bonds sound boring. Most people assume bonds are just for older investors. Well, guess what? If you're retired, you are old in investing terms, and bonds are actually your best friend. But we're not talking about just any bonds here. This is a specific bond fund that focuses on short-term, high-quality corporate and government bonds. Why short-term? Because when interest rates fluctuate, short-term bonds don't get hammered the way long-term bonds do. They're far more stable, much less volatile, and in a rising rate environment, you're not stuck holding bonds that have lost a massive amount of value. Short-term bonds provide flexibility, and that flexibility is priceless. At the same time, they still deliver income. It might not match the yield of a long-term bond, but the trade-off for safety is absolutely worth it. This bond exchange-traded fund generally holds bonds from investment-grade corporations and U.S. Treasuries, which means you're lending money to some of the most reliable, credit-worthy borrowers on the planet. The risk of default is extremely low. You're not going to get rich from this fund, and that's not the goal. The purpose is to include a portion of your portfolio that is stable, produces income, and rises when stocks fall. That's the magic of bonds in a well-balanced portfolio. They zig when stocks zag. During a market crash, this bond fund acts as your shock absorber. While everyone else is panicking and dumping stocks, bonds often rise as investors seek safety. That means even if your stock holdings are dropping, your bond holdings remain steady, or may even increase, helping cushion the blow and protecting your overall portfolio. This is exactly why bonds are essential for every retiree. It's not about being overly conservative for no reason, it's about being smart and protecting yourself from devastating losses. The yield on this fund usually falls around 3 to 4%, depending on current interest rates, and the expense ratio is extremely low, often under 0.1%. What that means is you're essentially getting institutional quality bond management for next to nothing. That's an incredible value, and it's one of the main reasons I prefer exchange-traded funds over attempting to buy individual bonds on your own, which is complex and costly for most people. Now, let's move to the third exchange-traded fund, and this one is the piece that really pulls everything together. This is a balanced fund that holds both stocks and bonds in a conservative allocation. Think of it as a one-stop solution for retirees seeking simplicity. You buy this single fund, and you instantly get diversification across asset classes without worrying about rebalancing or hitting the right mix yourself. These balanced funds typically hold roughly 40% stocks and 60% bonds, or sometimes a 50-50 split, depending on the specific fund. The stock portion provides growth and dividend income, while the bond portion delivers stability and safety. It's truly the best of both worlds packed into a single ticker symbol. For someone who doesn't want to think about investing every day and prefers a set-it-and-forget-it approach, this type of fund is perfect. What I particularly love about these balanced funds is that they automatically rebalance for you. When stocks rise significantly, the fund will sell some stocks and buy more bonds to maintain the target allocation. When stocks fall, it does the opposite, buying stocks at lower prices using bond holdings. This forces you to buy low and sell high, exactly what every investor should do, but most people fail at this because emotions get in the way. The fund handles everything automatically, which eliminates human error from the process. The returns on these balanced funds aren't going to skyrocket overnight, but they are reliable and consistent, which is exactly what you need in retirement. Over time, you can expect roughly 5 to 7% annual returns on average, with significantly lower volatility than a portfolio made up entirely of stocks. Most importantly, during market crashes, these funds don't collapse completely. They might drop 10 to 15% instead of 30 to 40%, allowing you to stay composed and follow your plan rather than panicking and making terrible decisions. The expense ratios on these balanced funds are also very low, typically under 0.2%, giving you professional asset allocation and automatic rebalancing for nearly nothing. Compare that to paying a financial advisor 1% of your portfolio every year, and you can see why I favor these funds. They save you thousands in fees while delivering the same or even better results. Here's the strategy one recommend for most retirees, and this is crucial, so pay attention. You don't have to pick just one of these funds. In fact, you probably shouldn't. The smart approach is to use all three together in a way that matches your personal risk tolerance and income needs. If you require substantial current income, you may allocate more weight to the Dividend Aristocrat Fund and the Bond Fund. If you can tolerate a bit more risk for growth, you could allocate a larger portion to the Balanced Fund. The goal is to construct a portfolio that lets you sleep peacefully at night. I've seen far too many retirees persuaded into aggressive portfolios by advisors promising huge returns. When the market inevitably dropped, they couldn't handle the stress, sold at the worst possible time, and locked in massive losses they may never recover from. That's a tragedy, and it's entirely preventable if you construct your portfolio correctly from the beginning. Think of it like this: if you have $1 million saved for retirement, you could allocate $300,000 to the Dividend Aristocrat Fund, $300,000 to the Bond Fund, and $400,000 to the Balanced Fund. This gives you diversification across multiple strategies and different asset classes. You get income from dividends, safety from bonds, and growth potential from the Balanced Fund. When one part of your portfolio is down, another part is likely holding steady or even rising. That's the beauty of this approach: you're not placing all your eggs in one basket. You're not depending on a single strategy or a single asset class to carry you through retirement. You've essentially built a fortress around your money, and when the storms hit, which they inevitably will, you'll be secure while others are panicking. Let me explain what happens when you don't have this protection in place. I've witnessed it repeatedly. The market is performing well. Everything is rising. People feel confident, maybe even arrogant, thinking they're investment geniuses because their portfolio increased 20% last year. Then, suddenly, a crash hits. It could be a financial crisis, a pandemic, or something completely unforeseen. All of a sudden, their portfolio drops 30, 40, or 50%, and because they need the money to cover living expenses, they're forced to sell at the absolute worst possible moment. That's a death spiral. Once you start selling in a crash, you're locking in losses that may never be recovered. And here's the most painful part. When the market eventually rebounds, which it always does, you miss out on that recovery because you already sold. You exited at the bottom, and now you're sitting in cash, watching everyone else profit while you're trying to figure out how to stretch your remaining savings for another 20 years. It's a nightmare, and it's entirely preventable. This is exactly why the 3 exchange-traded funds I just explained are so essential. They are designed to prevent that nightmare scenario from ever happening to you. The Dividend Aristocrat Fund continues to pay you dividends even when stock prices are dropping. The Bond Fund provides stability and often rises when stocks crash. And the Balanced Fund automatically rebalances to capitalize on market volatility without you having to lift a finger. Together, these funds create a portfolio that can withstand any storm. But here's something crucial you need to understand about market crashes: they are not rare events. They occur regularly. If your retirement will last 20 to 30 years, you are going to experience multiple crashes. That's an inevitable reality. The question is, will you be prepared for them, or will you be victimized by them? The choice is yours, but you need to make that decision now, before the next crash hits. I also want to discuss a topic that rarely gets enough attention: the psychology of retirement investing. This is where most people fail, not because they chose poor investments, but because they couldn't handle the emotional roller coaster. When you're working and consistently contributing to your retirement account, a market crash can actually be a benefit, because you're buying more shares at lower prices. But when you're retired and drawing money from your savings, a market crash can feel absolutely terrifying because you're watching your nest egg shrink while still spending from it. This is called sequence of returns risk, and it's one of the greatest threats retirees face. If you retire just before a major crash and are forced to sell shares at depressed prices to fund your lifestyle, you can permanently compromise your portfolio's ability to last. However, if you maintain the right combination of assets, including bonds and dividend-paying funds that provide stability and income, you don't have to sell your stocks at the bottom. Instead, you can rely on the safe portions of your portfolio while allowing your stock holdings to recover. That's the entire strategy in a nutshell. Let me give you a real-world example. During the financial crisis, the stock market dropped roughly 50% from peak to trough. If your entire portfolio was in stocks and you needed to withdraw $50,000 per year to live on, you were selling twice as many shares just to get that cash compared to pre-crash levels. That's devastating. But if your portfolio looked like the one I've been describing, with bonds and dividend funds, you could have taken that $50,000 from the stable, income-producing assets and left your stock holdings untouched. A few years later, as stocks recovered, your portfolio would be healthy and intact, rather than permanently damaged. This is exactly why I am so passionate about this strategy. It's not theoretical, it works. I've seen it succeed through multiple market crashes, protecting retirees' nest eggs while their neighbors' and aggressive portfolios were wiped out. The difference between success and failure in retirement often comes down to how you manage these crashes. And the best way to handle them is to design a portfolio that doesn't force you to make poor decisions under pressure. Now, I want to address something I know some of you are probably thinking. You might be wondering, Kevin, these funds sound safe, but what about growth? What if I live to 95? Won't I run out of money if I play it too safe? That's a very valid question, and here's my answer. First, these funds do offer growth. The dividend aristocrats increase their dividends over time, which means your income grows steadily. The balanced fund includes stock exposure, which also grows over time. You're not giving up all growth for safety, you're finding the right balance between income and capital appreciation. Second, running out of money isn't just about how much your portfolio grows. It's also about how much you spend and how you react to volatility. If you hold an aggressive portfolio and it crashes, and you panic and sell, you will deplete your savings far faster than someone with a conservative portfolio who stays calm and sticks to the plan. In retirement, behavior matters more than returns, and I cannot stress that enough. Third, you can always adjust your strategy. If you're 70 and your portfolio is performing well, and you want to take on a bit more risk, you can shift some money into more growth-oriented investments. But you do it from a position of strength, not desperation. You make calculated decisions based on your situation, not emotional decisions driven by fear or greed. That's how wealthy people think about money, and that's the mindset you need to adopt too. Here's another critical point to remember: the goal of retirement is not to die with the most money. The real goal is to live the life you want without running out of money. That might sound obvious, but you'd be surprised how many people forget it. They become so obsessed with growing their portfolio that they don't actually enjoy retirement. They're afraid to spend because they're constantly worried about the future. And that, my friends, is no way to live. With the right portfolio in place, using these 3 exchange-traded funds together, you can spend confidently. You know that stable income is coming in. You know you are protected against market crashes. You know your money will last for the long term. That kind of confidence is priceless. It allows you to truly enjoy your retirement instead of checking your account balance every day and worrying about the market. Here's what you need to do right now. If you're not already invested in funds like these, you need to make a change. I don't care if you need to sell some individual stocks or exit risky investments. Your retirement is far too important to gamble with. Open a brokerage account if you don't already have one and start building this portfolio. You can set it up yourself in about 20 minutes. It's not complicated. You're buying just 3 funds, nothing more. And here's the best part: once this is set up, you barely have to touch it. Maybe once a year you rebalance slightly if the allocation has drifted. Maybe you reinvest your dividends or take them as cash depending on your needs. But for the most part, you set it and forget it. You're not day trading, and you're not glued to the news every day, panicking over market movements. You have built a machine that generates income and protects your wealth. Now, you just let it run. This is how smart money operates. This is how you survive market crashes. And this is how you make sure you never have to go back to work at 75. And this is exactly how you leave a legacy for your children or your favorite charity when you're gone. It all begins with having the right foundation, and that foundation is built on safety, diversification, and reliable cash flow. Before we wrap up, I need you to do something for me. If this video helped you or if you learned something valuable, hit that like button right now. It helps others discover this information, and more people need to hear this message. Too many retirees are making mistakes that could cost them everything, and we need to spread the word. And if you haven't subscribed yet, what are you waiting for? This channel is all about protecting your wealth and making smart financial decisions. I release content regularly that can genuinely change your financial life. Subscribe, hit the notification bell, and become part of this community. We're building something special here, and I want you to be part of it. Leave me a comment below and tell me, are you going to implement this strategy? Do you already own funds like these? What's your biggest concern about retirement? I read every comment, and I love hearing from you. This is how we learn from each other and become smarter with our money. Listen, I know I come across as tough sometimes. I don't sugarcoat things, and that's because I care about your success. I've spent my entire career building wealth and helping others do the same. And I've learned that truth is far more valuable than simply making people feel good. The truth is that retirement can be scary if you're unprepared. But if you are prepared and have the right strategy, retirement can be the most rewarding time of your life. You've worked hard for decades. You've saved money. You've made sacrifices. You deserve to enjoy your retirement without stress and without fear. And the 3 exchange-traded funds I just shared are the foundation for making that happen. They're not flashy. They won't turn you into a millionaire overnight, but they will protect you when it counts the most. Remember, in retirement, it's not about hitting home runs, it's about not striking out. It's about staying in the game long enough to win. With these funds in your portfolio, you'll remain in the game no matter what the market throws at you. That's a promise. That's Mr. Wonderful's personal guarantee to you. Now, take action. Take control of your financial future. Build that portfolio, secure your retirement, and live the life you've worked so hard to deserve. Thank you for watching, and I'll see you in the next video.